Welcome everyone to this explainer. Okay, today we are unpacking some truly fascinating logic behind this current AI market boom. We're going to examine this really compelling case from our source material that suggests, well, that we might just be sitting on top of a massive AI bubble. And more importantly, we'll explore a surprising, strategic portfolio pivot designed to protect against it. It's a really structured, smart way to look at what's happening right now, and I am super eager to dive into this with you all.
Okay, let's dive right into this. Have you ever actually wondered if your safe, reliable passive index fund is secretly fueling a massive, debt-ridden AI bubble? I mean, for years, right? The absolute gold standard of investing has been the simple, low-cost S&P 500 index fund. It's passive, it spreads your money across the top 500 companies in the US, and historically, it returns about 10% a year. The whole idea is super simple. You don't pick winners, you just buy a slice of the whole pie. But according to our source, that supposed diversification, yeah, it's actually hiding a massive concentration of risk right now.
So let's break down exactly where your money goes when you buy into the S&P 500 today. Believe it or not, for every single dollar you invest, a massive 40 cents is funneled into just 10 companies. That leaves only 60 cents spread across the remaining 490 companies. It's wild. And that top 10 includes giants we all know: NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta. If we just set aside Berkshire Hathaway and JP Morgan for a second, the remaining giants at the top all share one very specific defining trait. They are all spending incredibly aggressively on artificial intelligence.
To make this concentration even more stark, let's talk about 7 to 8 cents. NVIDIA alone captures up to 8 cents of every single dollar you put into the index. Why does that happen? Well, it's because the S&P 500 is market cap weighted. That basically means the more valuable a company becomes, the bigger slice of the fund it automatically takes up. So your money is naturally and blindly funneled straight to the absolute most valuable companies, which right now are almost entirely driven by this huge AI hype.
Section 1. The Debt Feedback Loop.
$2 trillion. Our source points out that for all these top AI companies to actually justify their current, frankly sky-high valuations, they would need to generate around $2 trillion in revenue. Now, to put that completely wild number into perspective, that is more than the combined 2024 revenues of NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta. All of them. These companies are not being valued on what they earn today, right? They're being valued entirely on what investors expect them to earn in some hypothetical AI-dominated future.
And this brilliantly illustrates the massive disconnect here. It is staggering. For example, Sam Altman is reportedly willing to commit $1.4 trillion in spending for AI infrastructure, while OpenAI is currently only making somewhere between $13 to $20 billion in yearly revenue. They are financing this massive AI dream through astronomical, and quite frankly often hidden, debt. Essentially, these companies are just passing massive amounts of money around to each other to bump up their own valuations.
And so this creates a totally self-reinforcing mess. Think about it. Passive investment money automatically buys the biggest companies, which in turn pushes their stock prices higher because they're now worth more while they take up an even bigger share of the S&P 500, which means the very next batch of passive investment money buys even more of them. It's a continuous loop. According to data cited from Deutsche Bank, this whole AI spending frenzy is actually propping up the US economy. The argument is that without it, we would literally already be in a recession.
Section 2. Decoding the 4 investment zones.
So, how do we make sense of all this? The source breaks the current market down into 4 specific zones. First up, the crowded zone. This is your high valuations, heavy passive investment stuff. Think NVIDIA and Meta. Literally everyone is already there. Second, we have the defensive zone. These are the reliable, predictable cash generators like Walmart and Coca-Cola. Warren Buffett loves these because they just print cash no matter what the broader economy is doing. Third is the speculative zone. High hype, very low revenue. Think of the crazy pandemic-era runs of Peloton or AMC. That stuff is driven by internet momentum. It's honestly closer to gambling than actual investing. And finally, sitting right down there at the bottom, we have the overlooked zone.
Let's really focus closely on that overlooked zone for a second. Our source identifies this exact area as the absolute sweet spot for the upcoming era of technology. This is where small and mid-cap companies and agile little startups are operating right now. They're out there solving actual, real-world problems. But crucially, and this is the key, they are doing it without carrying the billions of dollars of AI development debt that the giant companies in the crowded zone are burdened with.
Section 3. Why the underdogs win.
Now, what's really interesting about this slide is the idea that we are actively entering an AI price war. See, these startups and mid-cap companies, they aren't building their own massive AI models from scratch.
Instead, they're building software that basically just lets the user choose between the big existing models, like Claude, ChatGPT, Gemini. Because these mega models are all getting pretty close in their actual capabilities, they're becoming totally interchangeable. And when tech becomes interchangeable, the creators are forced to compete on price. That creates a race to the bottom, which absolutely destroys the massive profit margins they desperately need to pay off those trillion-dollar debts.
Our source uses a really fantastic analogy here that makes this crystal clear. Imagine two gas stations right next to each other. One sells premium fuel for $3 a liter, the other sells standard fuel for $1.50. Sure, a few people with fancy cars are going to buy the premium, but most folks, they'll just buy the cheaper fuel because, hey, it effectively does the exact same thing. It gets your car from point A to point B. These massive AI models are rapidly becoming just like that standard fuel.
So, you can see the stark contrast at play here. Building AI? That requires billions in debt and carries incredibly high risk. But using AI, that is low cost and highly interchangeable. When a new technology becomes, good enough, the true financial value doesn't actually stay with the heavily indebted creators. Instead, it flows downward to the agile underdogs, those small and mid-cap businesses that are actually applying that cheap, powerful technology to solve real problems in the smartest, most efficient ways.
So the crucial point is, how do we actually navigate this? Well, our source outlines a really practical anti-bubble playbook. First, don't just panic sell. Keep the majority of your investments in the S&P 500 just in case this massive AI growth continues. Gotta hedge your bets, right? Second, diversify globally. History shows us over and over that market dominance shifts. Just look at the UK back in 1900 or Japan in the 90s. Third, actively look for those small and mid-cap underdogs who are smartly using AI. Fourth, increase your reserves in hard assets, things like physical gold and gold ETFs, especially as global trust in fiat currencies starts to shift. And finally, hold some cash. Even the ultimate value investor, Warren Buffett, is sitting on a staggering $347.7 billion cash pile right now, just waiting for the exact right moment to strike.
We'll end on this provocative question. When the AI arms race finally ends, and those trillion-dollar debts come due, who will actually hold the profits? Will it be the giant builders or the agile users? Thank you so much for joining me for this explainer. I really hope this structured breakdown gives you a totally new lens through which to view the technology you interact with every single day. Until next time, keep learning and keep questioning.